The currency translation gain is there and also loss is there. So we call this also a part of shareholder equity. Now let's just talk about some other stuff. What if you don't receive cash, instead you receive some assets against common stock? For example, I'm setting up my company, I don't have cash, and I call you, okay, I will give you 2000 share if you give me this chairs, ACs, and car or this building. Be my partner. All right? Don't give me cash, give me assets. So illustration is on November 12, Khan Corporation issued 15,000 share, one par value each, common stock for equipment with a market value of 4,000 and a building value 124,000. So did you receive cash? No. You receive building increase, debit 120,000. Equipment increase, debit 4,000. And common stock increases, credit side 15,000. Right? But remember, how many issued shares are issued? 15,000. Par value is 1. So it means common stock are only 15,000. But 4,000 and 120,000 is equal to 124,000 less 15,000 is the premium you received on the top of common stock. We call this additional paid in capital or paid in capital in excess of par, 109,000. So when stocks are issued on par value, remember they're going to be and paid in capital or not. Look for that. This is the trick. All right. Any question? Subhan, Faik, Sufyan, Mirko, Marco, Oliver,
Yeah.
our PD, Priscillo,
No questions, sir.
Venetia. Okay, good. Let's move forward. Now, common stock issued for services. What if you receive services and you don't have cash? You said, okay, be my partner, I can give you shares. That's it. So let's see the illustration here. So Han Corporation engages an attorney. The bill was 25,000 for the services, and the attorneys agrees to accept 25,000 shares, 2,500 shares, one par a value. So common stock value is 2,500. Service bill is 25,000. So the difference is the premium, the paid in capital. So since the legal fees is the expense, so legal fees increases, debit 25,000, common stock increase 2,500, and the excess of par is the paid in capital 22,500. That's it. So that doesn't mean that if you issue shares you only receive cash. You can issue shares in response to an asset, in response to a services as well. Right? Now the treatment of preferred stock. So they follow the same pattern as common stock. Entries are the same, just you write down the preferred stock. So they may have a separate account paid in capital in excess of preferred or common stock. So we call this paid in capital. If you receive premium on preferred stock, you write it down here. Paid in capital for preferred stock. And if you don't write it, automatically it means that we are talking about common stock. All right. So whenever you receive more amount in excess of par, and it is a preferred stock, then please do write the preferred stock. Paid in capital for preferred stock or paid in capital in excess of par value for preferred stock. All right. So preferred stocks can be issued for conversion purposes as well. For example, after 5 years, we can convert your preferred stock into common stock. We may have this kind of convertible feature as well, or we can give you some bonds in response to converting of preferred stock, because preferred stocks are rarely issued. Like we talk about that, only 9% for all over the market, only 9% companies issues. So normally companies don't issue that because there is a small difference between preferred stock and the bond. Both have fixed return. The bond return is called interest. The preferred stock return is called dividend. All right. So companies normally don't issue the preferred stock, but once they issued, they may have included the convertible feature. For example, after 5 years or after 6 years, the preferred stock can be converted into common stock or bonds as well. So we have illustration to make it more understandable that convertible preferred stock, par value 1, 50,000 shares issued at par. So 50,000 shares issued at par. So convertible preferred stock, its par value is 1, right? So preferred stock values were 50,000, and sorry, you issued convertible preferred stock of par value 1, 50,000 shares. So how much you issued? 50,000. You received cash 50,000 against preferred stock. So cash received to preferred stock, which is convertible. So this convertible is basically feature. Now what happened? You convert after some time into common stock. What will be the entry now? Convertible preferred stock to common stock at the rate 6.2121, which means for every one preferred stock you are giving 6.25 common stock to the preferred stockholder. So which means 8,000 shares of one par value common stock issued in exchange of 50,000 share of preferred stock. All right. So okay, I think we made a mistake here. Convertible preferred stock to common stock. So this is 6.25 preferred stock to common stock 1, which means that person who hold 6.25 preferred stock, he will be given 1 common stock. So the idea is 8,000 common stock will be issued against 50,000 share of preferred stock. So we are now converting the uh, preferred stock into common stock. So 50,000 is the cash behind the preferred stock, and we are giving them 8,000 par value 1 share. So which means the difference is 42,000, which is premium. Premium is called paid in capital. All right. So decrease in preferred stock is debited because we are eliminating this. So decrease in common stock, preferred stock is debited. So convertible preferred stock 50,000. Increase in common stock, credit. Increase in premium or increase in paid in capital, increase 42,000, again credit. So entry is okay. You just need to find out, in case of common stock, the premium. The premium of common stock is called additional paid in capital. Guys, you understand? Noon?
Yes.
Yes, sir.
Momo, understand? All right.
Yes.
Now, we talked about the authorized issued capital, so let's just talk about that. Authorized means maximum number of shares a company can issue under its charter. Issued means number of shares the company has issued to shareholders. And then there is another category which is called outstanding, which means the number of shares that are in the market right now. So it means something happened here between issued to an outstanding that we need to separate it from outstanding capital to issued capital. What is the idea? Idea behind, for example, company authorized capital is 10 billion shares. Okay, I cannot write. Okay. Fix this issue. Okay, we successfully resolved the issue. Okay, let's see that. So, can you see the slides, right? Can you see
Yes.
learning objective 3? Can you see that?
Sorry, what, sir?
Learning objective 3. Can you?
Yes.
Okay. Means everything is good. Okay. So, we were talking about the authorized, issued, and outstanding. So, there is a difference between issued and outstanding. For example, company has a charter to issue 10 billions of shares, and company issues only 1 billion. All right? And company, right now the shares in the market are 900 million. Okay, 900 million. What does it mean? It means company issued to the shareholder 1 billion shares, and in the market there are 900 million shares. So it means company buy back its shares worth of 100 million. So we call this treasury stock. Okay. Again, we are facing the same problem. Hope we can resolve it.